love the channel and find it useful in becoming a happy retiree. Subscribe today. Before we went to break, we talked about these esoteric, crazy ETFs that in the last few years have proliferated, that were used to bet against rising volatility. So these are ETFs that couple the ticker symbols. And again, these are nothing that I own, and I've never recommended these, but they became prominent. And we're talking $5 billion, $10 billion, $20 billion worth of different ETFs that access this piece of the market, SVIXY and XIV and EXIV. These are all ETFs and ETNs that were used to bet against volatility. Now, the volatility, as the market got more and more placid over the past 2 years and volatility went down, these ETFs shorted volatility. Remember, shorting means that you're betting against a stock or some sort of index to go lower. As it goes lower, you profit. And it became a very popular Wall Street trade. Billions of dollars short the VIX. And VIX is a measure of market volatility. It's calculated by the Chicago Board Options Exchange. And think of it this way. If the VIX is at 20 and it got down to the 9 range, but if think about the VIX at 20, then what that means is pricing in that there's a 68% chance, and 68% is one standard deviation either way, that the S&P 500 will trade in a 20% range over the next year, either up or down 20. That's that one standard deviation. That's what the VIX measures, if you've ever wondered. It's the range and probability of outcome over the next year for the S&P 500. That's a big part of what the VIX does. Traders can trade these VIX options and these contracts, and you can make bets. People making bets on this, and billions went into these ETFs, and they went up and they went up and they went up as volatility went down and down and down. And then because we were long overdue, so it got to be a very popular trade. We didn't talk a lot about it here on Money Matters because I think it's more of a trader's trade as opposed to an investor's trade. So if you're a hedge fund, you might have used this. If you're running some sort of long-short fund or what's called a risk parity fund, you may have owned these short volatility options. Again, nothing that you and I owned probably. And then because we were long overdue for correction, traders ready with their finger on the trigger at the first sign of a pullback, and boom, that's what happened. The VIX went up dramatically. It went from 9 to almost 40. So think about it. It had to double from 9 all the way up to 18 or 20, and then had to double again. I mean, think about that volatility change in an instant. The short ETFs that bet against volatility, they just collapsed. Some of them went to zero. So these are popular billion-dollar products, and they just went to zero in a couple of days, just gone. These ETFs just vanished. And think about that disaster. Think if you're a hedge fund or some sort of fund, you had $1 billion in one of these things. You lost $1 billion in like 24 hours, 48 hours. So it's part of the spark that led to this carnage. Again, I don't know exactly who owned these things. I know there were traders, not investors. And I know that the numbers we're talking about billions and billions of dollars. So that spark, these esoteric ETFs have been another part of, they themselves have been a disaster. And I think that these are also part of the beginning of the pullback that we saw. Now, what do these pullbacks look like absent of recessions? And absent of economic recessions. We go back historical precedents. Let's go back to beyond 1987, so 31 years. No bear market, and this is important to remember, no bear market has unfolded that was not ultimately associated with a recession. There have been 21, as I've recently just updated the statistic, 21 10% corrections plus in this period of time in the last 31 years. 21, if you count the most recent 10% corrections, 10% plus, 10% or more pullbacks in 31 years. The pullbacks that are associated with recessions have turned into what we know now as bear markets, 20% or more corrections. Again, the pullbacks that are associated with recessions that have turned into bear markets, 20% or more, the ones that have done that associated with recessions have averaged 25% downdraft. Today we're only at 10. Think about how painful 10 is. These are 25. So it's more than double where we have gone already. And think about the pain we've already experienced. Now, absent recessions, pullbacks during a period of time where the economy is not in recession and not going into recession, those drawdowns have averaged 14%. Big difference between those two. So here we are already down 10. So we actually hit down 10.5, the down negative 10.5% mark. If we don't go into recession, I'm going to go into the reasons why I think we're not headed there. I don't think we're headed into recession, and we stay into this area. Think another 5% pullback might be very, very believable or very, very much in the cards here. But my point, though, is that we're pretty close to that level now already. So it'd be a big difference to go a full 25%, but we're already down 10.5 to go another 5. It really wouldn't be that big of a deal. It really wouldn't be. It's not that much further to go. Another 5% or go maybe, and there's no way to know, but history tells us that from a percentage pullback perspective, we're getting close to a bottom as long as we're not headed into recession. Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.